David Kudla is founder and CEO and chief investment strategist at Mainstay Capital Management. And he joins us right now from Troy, Michigan. And David, it is the start of earnings season, and the big banks have reported, all the big banks have now reported, and it feels very much like expectations were high heading into this earnings season, and they've become a bit of a drag this earnings season. They didn't really deliver in terms of setting the tone and validating people's risk appetite. What do you think is behind that, David?
Well, we've had some good earnings report time on semiconductor. Some of the banks have beat, but last week or earlier this week, a little bit disappointing in terms of bank earnings. We're still looking for double-digit earnings growth through most of 2026. We think that we will have a rise in 26 in the markets, like in 25, much because of earnings growth and growth forecast for earnings growth rather than just multiple expansion. Last year, we had the tech stocks were up more than 20%, but their valuations by the end of the year were about the same as where they started because earnings forecasts continue to grow. We're at a record pace on double-digit earnings, and that's pretty much continuing into certainly what we're seeing for fourth quarter and what we'll see, we think, in the next few quarters.
David, early into 2026, investors have been rotating out of the big tech high flyers. Looking at the Russell 2000 index, it was up nearly 7% through yesterday's close. We've also seen the S&P equal weight outperform. Do you expect this broadening to continue? And also, what kind of tailwinds need to help those sectors do well?
Good morning, Alexandra. Yeah, we had in the second half of the year, we had the Fed cut 3 times. And when the cost of capital is declining, that's good for small caps. The large caps are a lot more equity than debt exposure. The small caps, it's about debt. And when rates are coming down, small caps rally. The thing is, we've seen so many head fakes over the years with small caps looking like they're going to start a run, and then it fades. As long as we have an environment, and we're looking at better than 5%, according to Atlanta GDP now, better than 5% growth in the fourth quarter for GDP. We have still consensuses for 2 rate cuts. We'll see how that pans out. There's politics involved and everything else. But when rates are coming down, we have an expanding economy. That's good for small caps and mid.
Gotcha. All right. Well, David, when it comes to some of your, not predictions, but your favored positioning, you were on with us in December and you talked a lot about precious metals. And of course, we saw gold and silver have this incredible run at the end of last year, and they have just continued to build on those gains this year, notwithstanding the fact that gold is edging lower a bit today. If people were to start adding gold to their portfolios, they may have missed, the initial run. What's the form that they should do it in? How would they express that?
Yeah, and it's actually that past month, if we just take silver, up 47% in the past month alone. And it's certainly reasonable for people to look at that, how much since January 1st, silver price has tripled by the SLV ETF. Gold has been in a long run for 2 years. The other metals are climbing. And it's certainly reasonable to say it's run too far. But the thing is, we're in a secular trend for the metals and the miners because of central bank buying of gold, because of investor speculation for all the metals and industrial demand and all the reasons we've talked about. So what investors can do is dollar cost average in. Today, those metals are down a little bit. They were down a lot more overnight and they've recovered. Silver's only down a couple percent, for instance. And, just dollar cost average into a position, because realistically, we could have a lot of setbacks like in October for a couple of weeks or 3 weeks. What we've gotten more of is a day or two, and then we're off to the races again. So I think the key is just average in. Those that have waited for a big downturn are still waiting. For a big pullback, they're still waiting.
David, it feels like everyone is optimistic that we'll get a 4th year of really solid returns on the S&P 500 this year. Almost no one is bearish these days. Does that worry you at all from a contrarian perspective?
Yeah, it worries us a lot, right? We look at these sentiment indicators and the indexes, and they're the needles going back up to exceedingly bullish, and when everybody's bullish and complacent, that's when we get worried. And we've got a couple of factors at work here. Usually the second year of a presidential term, the data changes a little bit if it's the second term. We haven't had it in a long time like this where there's another president in between. But in the second year of a presidential term tends to be the weakest year. And there's a bottoming sometime during the year and then a rally through the end of the presidency. So we've got that factor that has incredibly consistent. We don't want to say the past is prologue, but it's been very consistent over time. But again, earnings growth is incredible. GDP, that's a volatile number. GDP now, it was at 2.7% in the read before. It doubled to 5.4%. So, we'll see where we really come out. But we think that, you look at what President Trump is doing, there's all the indicators he wants to run the economy hot. Even if it means inflation, I don't think he's counting on that, but I think that will come if it runs as hot as we're going to. So, in that kind of environment, that can be tough for bonds. It can be okay for stocks, many sectors of stocks. What really benefits an environment like that is commodities, which we've already talked about, some of the hard commodities.
As much as people are looking for a fourth year of double-digit gains in U.S. stocks, one thing to remember is that U.S. stocks actually underperform the rest of the world, and emerging markets in particular were really taking off in the second half of 2025. And there's a lot of excitement around emerging markets going forward, especially given valuations. Where in the emerging markets do you start to look? I mean, emerging markets is so big, and it's not really instructive to just look at it as one big geography anymore.
Yeah, and that's one of the reasons that emerging markets on their own, you end up with a diversified position for your portfolio because there's all these disparate regions around the world. But what they're really benefiting from, those emerging markets that are commodity producers, that are commodity exporters, the metals we're talking about and other commodities. But there's also been this period of underperformance for emerging markets. And when interest rates come down in the U.S., that benefits emerging markets. So we like a diversified emerging market approach for those countries like Brazil, that are countries that are Eastern Europe, South America, those regions where there is significant exports of commodities. We expect those to do exceedingly well in 26. But we certainly like the sector, and it's another way we can diversify our domestic stock positions.
David, we have a Fed meeting later this month. Traders seem to be expecting the Fed to stay on hold with interest rates, but the data that we've gotten recently has opened the door for more cuts later this year. How much of your outlook for stocks is predicated on what the Fed does with rates?
We're always analyzing what the Fed is going to do. And as I like to say, our job is not to question the nobility of the Fed. It's to determine what they are going to do right, wrong, and then, anticipate that for the sake of our portfolios. What complicates it now is the politics involved. We just had this investigation, indictment into criminal activity on the new Fed building, and just how much politics have entered into it. We have a new Fed chair that'll be appointed in May. So the politics has played a lot more in the Fed than it has in decades. But we think that even if we get a Fed on hold, and Jerome Powell will be taking a lot of flack from President Trump for that, it's just incredible what's going on. The independence of the Fed being in question. But just looking at I think what the Fed would be looking at, we'll get a hold in January. We may be done. There may not be another rate cut in Jerome Powell's term through May, but that's okay. I don't think we need to predicate a forecast on that because, again, with GDP growing, earnings growing at the rate they are, we can have, with the Fed on hold, we can have stocks advance very well in these other areas. All
right, David, thank you for joining us. David Kudla, founder, CEO, and chief investment strategist at Mainstay Capital Management, joining us from Troy, Michigan.